What if instead of just shopping on Amazon, you could own a piece of Amazon? Or what if instead of owning some Apple AirPods, you actually own the Apple company? Well, you can do that through the stock market. The stock market is the most accessible wealth building tool that allows anybody to own a piece of the economy. But if you want to do it correctly, you have to know how the stock market works. You need to know how to actually invest your money into the stock market, because what ends up happening to a lot of people who want to invest their money in the stock market is they hear of the next big stock. They hear of the next big Apple, the next big Amazon, the next big Google on the news, and then they throw their money in because all their friends are starting to make money in this stock. But what ends up happening then to a lot of people when they do that is you end up buying high and selling low. Because you buy when everybody's excited about it, when the news is covering it, and then the stock starts to take a turn. And that's when a lot of people end up selling because they don't know why they bought in the first place. They don't know how to analyze the stock. They don't know what to do. They don't know what they were buying. And now you're losing money and you'll sold your stock for a loss. Even though over the last 100 years in the United States, we have seen the stock market grow. Yes, there's been booms. Yes, there's been busts. Yes, there's been recessions. Yes, there's been market crashes. But even despite that, we have seen the stock market grow even beyond the previous peaks before the bust, before the recession, time and time and time and time again, which means if you want to make money in the stock market, you need to know how to analyze the investments that you want to make. In this lesson, we're going to be going over analyzing individual companies. If this is a little bit too much, a little bit too daunting, that's okay. In the next lesson, I'm going to be going over how you can automate the entire process. So now when we talk about investing in individual companies, the first question you have to ask is, how do you want to get paid? Do you want to get paid when the stock price goes up, or do you want to get paid when a company has a big profit and they can share this profit in the form of a dividend? This is what cash flow is. This is when now a company is paying you money for doing nothing except owning the stock. Not every company is going to pay a dividend. A company is only going to pay a dividend if they have a big enough profit and now they don't want to keep saving the money and they don't want to invest this money back into the company and they just want to give it away to the shareholders. So if you go out and you buy one share of Amazon or you buy one share of Apple, you become one of the owners of these companies. And if the company that you're investing in is paying a dividend, well, now you would also get a piece of the profit given to you in the form of cash. Well, not physical cash. They're going to deposit it into your brokerage, but you're going to get this payment given to you just for owning the stock. So when you invest for dividends, you get paid without having to sell the stock. If you invest for appreciation, well, now you get paid only when you sell the stock and the stock price goes up. There's nothing wrong with either one. The question is, which one do you want to do and how do you analyze your investments? Now, when it comes to dividends, if you want to invest in companies that pay out cash flow, one of the simplest ways to analyze a cash flow paying stock is just how long have they been paying a dividend and how often have they been growing their dividends. Now, while history can't always predict the future, it can be a good indication and it's a great starting point. And so one of the things that you can do if you're interested in investing for cash flow is just to look for companies that have been consistently growing their dividends for a long time. And this is where you can look at things like dividend achievers, dividend champions, and dividend kings. What are these things? Well, these are terms given to companies that have been consistently growing their dividends. A dividend achiever is a term given to companies that have consistently paid out and increased their dividends for at least the last 10 years. A dividend champion is the term given to companies that have consistently paid out and increased their dividends for at least the last 25 years. And a dividend king is a title given to companies that have gone out and paid dividends and consistently increased their dividends for at least the last 50 years. So now you can just go on to whatever search engine that you want and research dividend achievers, dividend champions, dividend kings, and now you have a list of companies that have consistently been increasing the dividends. Again, nothing is guaranteed, but if a company has been consistently increasing the dividends for a number of years, that gives you at least a good starting point. But then if you want to analyze the company itself, because you do not, I'm going to say this one more time, you do not want to invest in a company just because of the dividend that they're paying. You want to invest in the underlying asset, not just the cash flow, but the asset, because if you can invest into a good company that's paying out a dividend, well, that's going to give you the ability to see dividend growth. But the key is you have to also analyze the underlying company and make sure that the company that you're investing in is a good company, it's growing, is innovating, and is providing a good product and value that people want to continue paying for. And so now when you do the analysis for a company, the first thing that a lot of people like to do is they want to go right into the financials. But for me, that's the last thing that I do. Because before I jump into the financials, I like to do the more almost touchy-feely type of stuff, which is, what is the company doing? What do people feel about the company? And this is something that you can't get out of the numbers. Because if you know that a company that you like is used by all of your friends, and people love talking about how great this company is. And every time you go to the store, every time you go to this place, there's a line out the door and there's always this big waiting list and there's so much demand for this company. That's a great sign. If you know that this company is really hip with innovation, they're always striving to create the best products, they have something that other companies can't compete with, that's a great sign. And so the first thing is really just, is this company producing for tomorrow or is it producing for yesterday? Because a company could have great financials, but be stuck in their ways and not want to innovate. I mean, just take a look at companies like Sears or Bed Bath & Beyond. These were at one time category killers. Sears and Bed Bath & Beyond were innovative. They were market just dominators. But eventually, they became comfortable with their positions, and then they got taken over by more innovative companies, and now they're both bankrupt. So you want to make sure that the company that you're investing in is still innovating for tomorrow. Just because it's great today doesn't necessarily mean it's going to be great 5 years from now or 10 years from now. Then the second thing that you can look at is something called a company's moat. This was a term that Warren Buffett, the famous investor, kind of termed and coined. When Warren Buffett talks about a company's moat, what he's talking about is, well, if somebody was going to attack this company, think about the old castles with moats around them. If somebody, an army, went to attack this castle and there was a small little moat around it, well, it wouldn't be that hard for the army to cross that moat and attack the castle. But now if you have a huge moat and you got alligators in there and you got just a very tough moat to cross, well, now an attacking army is going to have a much more difficult time attacking the castle. It's the same thing in business. If a company has a larger moat, it's more difficult for a competitor to come in and attack or compete and take over their position. So an example of this would be, you can think of Coca-Cola. Coca-Cola has a very large moat. And the reason why is because, number one, they have such a strong brand identity. You can put Coca-Cola on the shelf with a non-branded cola, and you can charge a lot more for the Coca-Cola, but people will still want to pay the premium price for the Coca-Cola versus the unbranded cola because people love Coca-Cola. And then the second thing that Coca-Cola has for their big moat is they have these strong contracts with restaurants, with movie theaters, with venues all across the world. So if a competitor cola wanted to compete against Coca-Cola, number one, they're going to have to go up against this brand identity. And then number two, they're going to have to get Coca-Cola to cancel all their contracts or get the venues to cancel all their contracts with Coca-Cola. That makes it more difficult for a competitor to compete against Coca-Cola. You can compare that to something like a fashion retailer for high schoolers. Fashion is changing all the time, and you don't have that same brand loyalty with products that sell fashion for high schoolers because that's going to change every couple of years. So you don't have that same moat, and a new company can come out, create a new trend, and that old fashion line is obsolete. So before you go out and start analyzing the numbers, start taking a look at the innovation. Is this company creating something that people really want, and are they innovating for tomorrow? Second, what kind of moat do they have? How hard would it be for a competitor to come in and take a company's spot? Once you do that, now you can start diving even deeper into the fundamental analysis of a company, because we're not talking about trading. What you're doing here is you are investing into a company's future. You want to invest into a company for the long term. We're not talking about 6 months or 9 months or even a year. We're talking about years, if not decades, because now you want to invest in something for the long term. So now, how do you do that? Well, the first thing that you can do, and the simplest way to start, is just by looking at a company's investor presentation. Every company that trades on the stock market has an investor presentation. You can generally find this on a company's website. If a company trades on the stock market, they will have something called the investors relation page on their website, or you can also go to the SEC website and you'll find a lot of that company's information over there as well. But this investor presentation is a company's pitch to get you to want to invest in them. So if you read through this investor presentation and you say, I don't want to invest in this company, well, that is a very big red flag, because this is a company's pitch showing you their best thing. This is their highlight reel. This is why you should invest in this company. So this should be kind of like oh yeah, I love this company. Because if you don't really love the company after the investor presentation, you should not go any further in your analysis, because this is a company selling themselves to you. So take a look at the company's investor presentation and see what it looks like. Is this company creating products and value in a way that you believe in for the future and something that you identify with? The second thing you want to take a look at is now listening to the company's earnings calls. If a company is publicly traded on the stock market, they are required in the United States by law to host these earnings calls, which you can listen to for free, where the company is just going to talk about how they did over the last few months, how revenues have grown or shrunk, how their costs have grown or shrunk, and their predictions and outlook on the future. So this is where the company is going to just tell you what's going on inside of the company, and people will ask them questions. There will be analysts on the call that will be asking them questions, and just listen in to see, is this something that sounds attractive or not attractive? Does the CEO and the CFO and the other executives in the company sound very optimistic, or do they not sound very optimistic? And you can kind of just get that feel through the earnings call. And if you still now, after the investor presentation, after the earnings call, you still like the way that the company is looking, the next thing you can take a look at are now the financial statements of a company. And the way that you can find these financial statements is you can either go to the company's website, they will have an investor relations page, or you can go to the SEC website, and this information will be there over there as well. But every quarter and every year, these public companies are required to put out statements called 10Qs for the quarterly reports and 10Ks for the annual reports, where the companies will have to disclose their financial earnings and losses and everything in between. And there are three main financial statements you want to take a look at. Number one is the balance sheet. Number two is the income statement. And number three is the cash flow statement. Your balance sheet, you can kind of think of like a net worth statement. This is the assets and the liabilities of a company. This is going to show what type of assets they have and what type of liabilities they have. The income statement is your profit and loss statement. This is going to show how much money the company made, revenue. Then it's going to show the different operational expenses and the other expenses, and then their net profit. So you can see now, has their profit been growing? Has it been decreasing? Has their revenues been growing, or have they been decreasing? Have their costs been growing, or have they been decreasing? And these are the questions that the things you want to look at. And this is going to be all disclosed on the 10Ks and the 10Qs. The 10Ks, the annual reports, are going to have more accurate information. But you can take a look at this data, and then there are websites on the internet that will also curate this data to make it easier for you to find. But I would recommend, especially in the early stages of you doing your research, go directly to the source, read these actual financial statements, and see what's going on with their revenues, their operating expenses, and their net incomes. Are their profits increasing or decreasing? Are their revenues increasing or decreasing? And are their costs increasing or decreasing? And then ask the question, why? And you will be able to find some of this information in these earnings statements by listening to the earnings calls, because they might say, yeah, our costs are going up because inflation is really high, because it's becoming harder due to regulatory changes for us to continue operating. And then you can start to think, is this a good thing or a bad thing? If they say that their costs are rising because they're investing heavily into the future products they have, well, that's a good thing. If their costs are rising due to new regulatory changes, that's a bigger red flag. Just like that, take a look at their revenues. Are revenues dropping, or are they rising? And if they're rising, how fast are they rising? And you can compare that to other competitors, because if this company's revenues are rising much slower than what their competitors are rising, well, then that's kind of a red flag. If their revenues are rising faster than the competitors, that's a good sign. Same with the profits. And then the third statement you can take a look at is the cash flow statement. The cash flow statement shows you what's going on with the cash in the company. How did it flow through the company? Cash is the lifeblood of every company. And so this will show you how is cash flowing through the company. So what you want to do now is just read through these statements and see what's going on with the numbers and start asking questions. If now, after looking at these numbers and you look at the competitors of this company and the numbers still look good to you, then you can dive even deeper, and now you can listen to the expert analysis calls. There are services that you can pay for to hear these. You can listen to some of these on YouTube, some of these on podcasts. But what you want to listen to is analyst opinions about the company that you want to invest in. But the key here, listen to me carefully, is you want to listen to analysts that disagree with one another. If you want to invest in a company and you only listen to analysts that say why this company is a great buy, well, you're going to get into this confirmation bias where everything sounds like it's amazing and you're not going to hear the actual red flags. So listen to the people that say that the company you want to invest in is a great investment, and then listen to the people that say that the company you want to invest in is a bad investment. And now start to formulate your own opinions. You've looked into the company, you looked into the moat, you looked into the innovation, you looked at the financial statements. Now you're looking at people's opinions and analysis on the company. And if you still like it, if you still like this potential company, even after listening to disagreeing viewpoints, then what you can do is now start doing some financial analysis. Now, there's an infinite number of different ways to do financial analysis, but what you're trying to figure out now is the current stock price. Is the current stock price too high, or is this a good time for me to buy? But beyond just the stock price, what you want to take a look at is the market capitalization. This is how much the company is actually worth. You don't want to just look at the stock price by itself because, well, a stock trading for $10 a share or a stock trading for $100 a share doesn't give you any information. What you want to look at is the actual net worth of a company, which is called the market capitalization. And the way that you get the market capitalization is you take the current stock price and you multiply that by the total number of shares outstanding. So if a company stock is trading for $10 a share and there are 100 shares outstanding, that means that the market capitalization is 1,000. This company is worth $1,000. So now the question is, if this company is worth $1,000, is this a good investment for you or not? And this is where you can do different types of fundamental financial analysis. The simplest kind of old school financial metric is called the book value analysis. And what you do here is you take a look at the assets of a company, you subtract the liabilities, and that's going to give you the book value of a company. And the reason why this became popular in the past was because what some people did, they were often known as corporate raiders, is they would look for companies where the book value of the company was higher than the market capitalization. I'll explain what that means. Let's assume that a company invests in real estate and they own real estate worth $1 billion, but they also have debt on the real estate. So they have $1 billion worth of assets, but $500 million worth of liabilities, loans, which means the book value is $500 million. This is the assets minus the liabilities. But what if the market capitalization on this company was just $400 million? Well, now you can come in and buy shares in this company. You're buying the company at $400 million, even though the assets are worth $500 million. So some people would go out and try to find deals like this and buy as much of the company as possible and then essentially liquidate the company, aka sell off all the assets, because if you can buy the entire company for $400 million, because that's what the market capitalization is, and then you sold off the assets, all the real estate, and you can generate $500 million worth of proceeds after paying off the debt, well, you just made $100 million because you bought the book value for lower than what the market capitalization is. And then you can start to get even more deep in your fundamental analysis. So you can take a look at things like your EBITDA analysis. If you've ever seen that show Shark Tank on TV, they also have the show Dragon's Den. What people do is investors go on and they say, I want to sell 10% of my business for $100,000, meaning my company is selling for 10 times earning. It's worth $1 million, but I'm willing to sell 10% of it for $100,000. Well, that's what the EBITDA analysis tells you. And you can see this on pretty much any stock website out there, where the EBITDA analysis tells you that this company is selling for a certain multiple of earnings. So if you go to Yahoo Finance, for example, search any stock that you want, you will see something called the P/E ratio, which stands for price to earnings ratio. And what this does now is it takes a company's earnings, their profit essentially, and then they apply this multiple. You'll see that some companies are selling for 15 times earnings, some 40 times earnings, some 50 times earnings. And what you want to do is, relative to other competitors, is this company being sold for a higher multiple or lower multiple, and what's a good multiple for you? And what you'll see is some industries sell for much higher multiples, some industries sell for much lower multiples, and this is where now you got to figure out what type of investor that you want to be. What we've seen in the past is that a lot of your traditional value investors, like what Warren Buffett does, generally look for companies that have EBITDAs at 15 or under. That doesn't mean you shouldn't invest in any company that has a multiple higher than 15, but this is just kind of the average of what we've seen with some types of investors. And now what you can do is figure out what's a good multiple for you. Another ratio that you can take a look at is the PEG ratio. And many investors like to look at the PEG ratio to help give them an idea of whether a stock is overvalued or undervalued. And so the way that you calculate the PEG ratio is you take a look at the price to earnings and you divide that by the growth. So what that means is you take the current price of the stock and you divide it by the earnings, and that gives you a price to earnings number. These numbers are all public, by the way, so you don't have to always calculate it yourself. You could take a look at some tools and softwares on the internet that will give you these numbers for you. So you take a look at the price to earnings number, and then you divide that by the growth rate of the company. And now when you get this number, it's going to be, let's just say 1.2. If the number is 1.2, that generally means that this company is overvalued. Not always. Again, this is just kind of a general starting point. But now many investors like to look at a number above 1 as an overvalued company. If investors see a number under 1, then that generally indicates that this company is undervalued. Again, I say generally because there's always exceptions, but now as you do your analysis, you try to look at a company. Okay, what type of company is it? Are they innovating? Do they have a big moat? I like the company. I like the products. I think people will continue to want this company's products in the future. Now you start to do more of the deeper fundamental analysis. Now you start taking a look at things like their investor presentation. Then you take a look at their earnings calls. Then you start to listen to expert analysis. And now you start looking at the numbers. Are their revenues growing? Are their revenues shrinking? Are their profits growing? Are their profits shrinking? And as you start to dig through this, if you still like this, now you start to do your own financial analysis. Now you start to look at things like, well, what is the PE ratio? Is this in line with what I'm looking to invest in? Is this a good number based off of what the industry standard is for this type of company? You'll see tech companies have a different PE ratio than healthcare companies, and healthcare companies have a different PE ratio generally than real estate companies. So is this in line with what I'm looking for, especially in this industry? And then you can also take a look at something like the PEG ratio to see, well, is this company overvalued or is this company undervalued? And this is the fundamental beginning of you starting to invest. And the one piece of advice that I want to give you at the end of all of this is you can do everything right and still be wrong. That's one of the perks of investing, that there's risks associated with investing. And you have to understand that before you go in, because if you dump all of your money into an investment, and you can't lose that money, well, now you're taking on a lot of risk, because investing has risks. And one of the ways that you can mitigate your risk is just by investing for a longer period of time. The second way that you can mitigate your risk is by doing more research on investments and learning how to invest. But this is now just the beginning of how you can start fundamentally analyzing your investments. And what you'll see fundamental investors do is they will spend hours and hours and hours just digging and combing through the numbers, because there's an infinite number of ways now that you can value and understand the financials of a company. What I'd like you to do now after this lesson is go out and look around you. Look in your house, look in your room. Where are you spending a lot of your money, and which of these companies are publicly traded on the stock market? Make a list of 3 companies that you're already spending money on that are traded on the stock market. Then, once you make this list of 3 companies, I want you to dig a little bit deeper into these companies. Look at number 1, what is the market capitalization of this company? Number 2, what is the share price of this company currently today? And then number 3, what is the PE ratio of this company currently today? Once you do that, I want you to go a little bit deeper, and I want you to find the 10K and the 10Q for this company. Maybe you'll find it on the company's website. Maybe you'll find it on the SEC website. But go and just start reading through the 10K and the 10Q and read through the different financial statements. This is going to help give you that practice that you need, because investing takes practice. It's not going to happen just by watching lessons. You got to go out and do it yourself, because experience is the best teacher, and no amount of videos is going to bypass the education that you're going to get from experience. All right, that's it for this lesson. And in the next lesson, I'm going to talk about how you can just automate the entire process and not have to do all of the analysis that I talked about here.